Howdy everybody, welcome back to accounting. I'm Professor Martin, and I just said welcome back to accounting. The fact of the matter is our topic today could fit into financial accounting, it could fit into managerial accounting, it could fit into intermediate accounting. We're going to be taking a look at the cash flow statement, one of my favorite financial statements. I'm really excited to be able to share it with you today and walk you through what goes on in the cash flow statement. So hopefully by the time you're done with our video, you'll not only know what's on the cash flow statement, what it's trying to accomplish, but you'll also maybe be prepared to start to try to make one of your own and tackle our homework problem. So here we go. We got four financial statements that we've talked about. We've talked about the income statement, the old profit and loss statement, where we have revenue minus expenses, hopefully equaling a net income or net earnings. I say hopefully because if our expenses are more than revenue, we have a net loss, don't we? And that's bad. And so we have the income statement. We also have our balance sheet. Old balance sheet assets equals liabilities plus owner's equity. And we see that on the balance sheet, summarizing what we own and who has a claim to it. We've also talked a little about the statement of shareholder or stockholder's equity. That statement simply shows all our equity accounts and how they change from one period to the next. So we're down to the cash flow statement. How did our cash balance go up or down from one period to the next? That statement of cash flows is going to show you that information. Where did our cash come from? Where did it go? Our sources and uses of cash are going to be demonstrated on that cash flow statement. So those are the four biggies. There's one more financial statement required by GAAP. It's called a statement of comprehensive income. We're not going to worry about that right now. We'll let the people in intermediate accounting worry about that one. For our purposes, we're all about the cash flow statement. And I'd like to use Wal-Mart as an example. Boy, does the cash flow at Wal-Mart. You go into Wal-Mart these days, you buy a roll of paper towels, you grab a thing of shampoo, maybe a pack of socks, grab a thing of beef jerkies, you're walking up to the register, they scan it all in, and then you scan it all and it's like $118. You're like, what in the world did I just buy? I got to put that beef jerky back and try to get this thing under 100, right? Cash is flowing at Walmart. It's coming in, and of course Walmart is sending cash back out, paying for all the things that they're buying. So we're going to use Walmart's financial statements as an example of our cash flow statement. So why do we need a cash flow statement? We got the income statement, we got the balance sheet, statement of owner's equity. Why do we need a cash flow statement? Well, let's take a look at that balance sheet and income statement at Walmart. You can see right here on our balance sheet for Walmart, they almost doubled their cash between 2020 and 2021. We look at that income statement, they had $13.5 billion or $13,510 in net income. And so we add that into 2020's cash balance, you get something like $22,500 or $22,900. Well, that's quite a bit more than what they're showing in cash. And so you can't just look at net income and assume it all goes to cash. I'm sure some of it probably does. And so we kind of need another statement to show us, hey, this is where cash came in the door. This is where cash went out the door. Here's how overall our cash went up or down. And that's pretty important information. So we have the cash flow statement. Shows our cash balance and how it went up or down from one period to the next, from one year to the next year, or from one quarter to the next quarter. It is the only cash basis statement that we make. Your income statement, your balance sheet, statement of shareholders' equity, those are all done on the accrual basis, which is basically how we've been doing all the accounting that we've been learning. We've been doing the accrual basis, right? And that accrual basis means that we are recording a transaction whether or not it involves cash. We sell a product on account. We record accounts receivable, we record revenue, even though cash didn't trade hands. So in accrual accounting, we're recording transactions even if cash doesn't trade hands. In cash basis, we're only recording transactions when a dollar trades hands. All right, there's no accrual accounting. And so everything we've done is on the accrual basis, but now we have a financial statement where it is done on the cash basis. So guess what? To make that financial statement, the cash flow statement, we got to strip away all the accrual accounting. And I'm going to show you how to do that here in a moment. Our cash flow statement has 3 distinct sections, and they're ordered in the exact same way every time you see a cash flow statement. Our first section is operating activities. That part is going to capture the cash flows from the day-to-day operations of the business. And so you think about Walmart. What are their day-to-day operations? Well, they buy inventory, they put it on a shelf. I, as a customer, go in and buy it, check out, and I take it with me. That's Walmart's day-to-day business, buying and selling inventory, right? Now, every now and then, maybe they'll sell off a building. Like maybe they decide to close down a supercenter in a bad, underperforming area, in a bad market, and they sell that building. Well, that's not really an operating activity. Walmart's not in the business of buying and selling buildings. That would be more of an investing activity. Investing activities is part 2, or section 2 of our cash flow statement. Investing activities, they capture the long-term property, plant, and equipment, or long-term investment transactions. So when Walmart buys or sells property or buys or sells another long-term investment, that information is going to appear in the investing activities part of the cash flow statement. Then finally, our last section is financing activities. Those transactions are going to involve long-term debt or shareholders. What I mean by that is maybe Walmart borrows money long-term. They sell bonds, collect money from issuing bonds, or they pay back bonds, or maybe they issue stock, or they buy back stock, or they pay a dividend to the shareholders. All of those would be examples of financing activities. So we kind of take the activities, lump them into one of the 3 categories here, and it helps us determine dollars in and dollars out, where the dollars came from, where they went. So let's take it step by step here. We're going to look at the operating activities. What I have in front of you is our operating activities, part of the cash flow statement for Walmart. And you can see right there the heading, cash flows from operating activities. Again, our day-to-day operation of selling inventory, buying and selling inventory. See, all the amounts again are in millions. And our operating activities in the kind of cash flow statement we're going to do are always going to begin with net income. And we're doing something called the indirect method. There's actually 2 different ways of doing cash flow statements, an indirect and direct method. By far, the most used is the indirect method. And that indirect method always begins with net income. And you see right there, the $7.179 billion in net income comes right off the income statement. So the question is, how much did Walmart generate from their day-to-day operations? Look down here at the bottom of that section, we can see net cash provided by operating activities, $27.7 billion. What that means, Walmart reported net income on the income statement of $7 billion. But by the time we strip away all the accrual accounting, they ended up generating $27.7 billion in cash dollars from their day-to-day business operations. That's a pretty big difference. So the first thing we kind of have to tackle on the cash flow statement and the operating activities is getting us from that net income number to how many dollars were actually generated from those day-to-day operations. So to do that, we got to strip away all the accrual accounting. And that's why they call it the indirect method, because we're getting to that cash generated by operating activities indirectly. We're starting with a number of net income and then indirectly getting to operating activities by stripping away all this accrual accounting. We're adjusting for gains and losses, and we're also adjusting for changes in current assets and current liabilities. I'm going to walk you through what these adjustments are. You can see right there, adjustments to reconcile net income to cash provided by operating activities. So we're going to take it step by step here. First part, right there at the top of the cash flow statement, we've got the net income. Our first adjustment says depreciation and amortization. And you can see we're adding back $10.6 billion. Well, why are we doing that? Why are we adding that number back into net income? We need to think about the journal entry for depreciation. And you all made that in financial accounting. You know the journal entry. When we journalize depreciation, we debit the expense account, don't we? We increase our expenses. And then we credit accumulated depreciation. That hits the balance sheet as a contra asset account. We know that already. What you don't see in that entry is cash. When we depreciate assets, we don't write a check. There's no money going out and coming in. No cash involved. And so you think about that entry and what it does to net income. That entry lowers our net income, doesn't it? It lowers our net income because it made expenses go up. But since it doesn't involve cash, and we're trying to get to just dollars in and dollars out, we got to add that back in. Think about that for a second. I'll say it one more time. We made an entry that hit net income, hurt it. But because it doesn't involve a dollar, we got to reverse the effect of that out. We got to strip away the accrual accounting. And so I'm adding it back in. All right, I'm adding it back into net income. Again, we're just trying to get net income to dollars in and dollars out. So I'm adding that back, and I will always, like Walmart, always low prices, always add back what's been depreciated or amortized back to net income on the cash flow statement. So every single cash flow statement that you look at that's done in the indirect method, that first line is usually always going to be adding back what's been depreciated. I say usually because if they didn't depreciate anything, then it wouldn't be there. But for the most part, line number one after net income is going to be where we add back what's been depreciated. I'm always going to add that back. Let's go one step down the line here. Right after we've added back what we've depreciated, you notice we have unrealized gains and losses and gains and losses for disposal of business operations. Okay? And so these are basically the gains and losses that have occurred outside of the day-to-day, everyday operations of buying and selling inventory. Like I mentioned earlier, where they sold off a building. Right? That actual money they got from selling the building would go in investing activities, but the gain or loss is going to show up here in operating activities. We've got to be able to handle it. Now you'll notice gains on both of those are in parentheses, meaning they're going to be subtracted. Losses, you can tell, they're not going to be subtracted, they're going to be added. So what's the reasoning behind that? Think about the journal entry one more time here. I just made up some numbers. The number right there, loss on disposal of land, I pulled from the cash flow statement. But let's say for the sake of argument that Walmart had land or a building that they paid $10 million for. And they sold it off and they got $5.15 million. Just to throw a number out there. Well, the difference between the amount they received and the amount they had in it would represent a loss. They sold it for less than they had it on the books. And so you can see they have a loss of $4.85 million, 4.85 billion, whatever the case might be with the extra numbers we threw on there. But that represents a reduction of net income. Losses, like expenses, are going to reduce net income. So it's the exact same idea as where we depreciated. It hurt net income, but that loss right there didn't have anything to do with the dollar in and dollar out. The cash part we would have added into the investing activities part. So this loss right here, it hurt net income, but didn't really have anything to do with a dollar. And so we need to add it back. Just like depreciation, it hurt net income, doesn't have anything to do with a dollar, we add it back to the cash flow statement. Gains are always going to be subtracted from net income on the cash flow statement. Losses are always going to be added back to net income on the cash flow statement. All right, we'll keep moving our way down here. The next little part, after we get through with the depreciation and these gains and losses, we have changes in certain assets and liabilities. When it says certain assets and liabilities, it's talking about operating assets and liabilities, more commonly known as current assets, current liabilities. So we're looking here at changes on the balance sheet from one year to the next in our current assets and current liabilities. And we're looking at how they went up or down in order to make our adjustments on this part of the operating activities. So right there at the top line, you have receivables, net, and you can see we're subtracting 368. So what's going on there? Why are we subtracting 368? I want you to think about the journal entry. When we sell on account, what does that journal entry look like when we sell an item, service, or a product on account? You think we got a debit to account receivable? We got a credit to sales revenue, right? No cash involved here. And you can see we're subtracting 368 in receivables. So I just went ahead and used that for my sample journal entry here. That entry, revenue is increasing. We're improving net income. We're increasing net income via revenue, but that entry doesn't have anything to do with cash. So imagine that Walmart had no other accounts receivable transactions. They didn't collect any, and they didn't write off any. This was basically the only AR transaction they had during the period. They've increased revenue, increased net income, but cash is not involved. So we need to strip that away. Thus, the negative number right there. So we're subtracting 368. Here's your rule of thumb on current assets. We compare on the balance sheet the current asset for 1 year and the current asset for the next year, for prior year and current year. If the current asset goes up, we subtract that difference on the cash flow statement just like I showed you right there. If the current asset goes down, we add the difference back into net income on the cash flow statement. So we're doing opposites. We look at that cash flow statement for Walmart. You can see receivables went up from 1 year to the next, and inventories, another current asset, went up from 1 year to the next. So we're subtracting them out. When the current asset goes up, we subtract it. When the current asset goes down, we add it back in. Why would we add it back in? Think about receivables again. When we collect a receivable, it goes down, but what do we get in our hand? Cash dollars, right? So your receivable goes down, we add it back in. On current assets, it's opposite. What about the current liabilities there? You see, we've got accounts payable, accrued liabilities, accrued income taxes. Look at the income taxes payable. You'll notice on the cash flow statement, it's a negative. Think about the entry to make a payable go away. If I want to make income taxes payable go away, I debit income taxes payable and pay it off, credit cash. So I have to let cash go out the door in order to get rid of that current liability, right? So cash is going down. Decrease in a payable requires me to spend money. So it's subtracted. Look at wages expense here, just as an example. We'll say that's our accrued liability. Wages expense, you see we are adding that in. I've recorded a debit to wages expense, a credit to wages payable. That increase in a payable means we've got the benefit of something without having to pay cash for it yet. So we're adding that in to the cash flow statement. Our rule of thumb on current liabilities, comparing prior year to current year. If the current liability goes up, we add that difference onto the cash flow statement. If that current liability goes down between the 2 years, we subtract the difference from net income on the cash flow statement. So you got a few rules that you might want to jot down there. Current liabilities, they move in the same direction. If the current liability goes up on the balance sheet from year 1 to year 2, then we add that difference. If the current liability goes down, we subtract it, moving in the same direction. Current assets move in the opposite direction for the adjustments on the cash flow statement. The key point, we make the adjustments in the operating activities of the cash flow statement to strip away all that accrual accounting that had been done. In other words, we are converting the accrual basis financial statements to a cash basis financial statement so we can look at dollars in and dollars out. That's all we want to see on the cash flow statement. The dollars that came in, the dollars that went out, and how the interplay between the two made our cash balance go up or down during the period. So cash flows from operating activities. Normally we have a net cash inflow from operating activities. You saw Walmart had $27 billion in cash that they had generated just from their operating activities. If that's not the case, then a business has continuous net cash outflows from operating activities, meaning they're losing money on the day-to-day operations of the business. They're not going to be in business for very long. In our fun times last week, we looked at Jones's Soda. In one of our discussion boards, I pulled up the cash flow statement for Jones's Soda here. As you can see, we've got the operating activities part. Down here at the bottom, we see that Jones Soda is burning through cash from their day-to-day operations. In 2021, they burned through $3.4 million. In 2022, they burned through nearly $6 million. What that means is Jones's Soda, in their day-to-day operations, lost $6 million. A company is just like you or I. If we have an amount of income coming in and we spend a lot more than that income coming in, we got to plug that hole, don't we? How does a business, or how do we as people plug that hole? Well, one thing we could do, sell off our assets. Maybe we could sell our car. Maybe we sell our house. Maybe Jones and Soda could sell off property or a patent that they might have. Sell off assets. Raise money to help plug that $6 million hole. Or we could borrow more money. I could go to the bank and say, hey, I need to take out a loan. I can't make ends meet. Same idea for Jones and Soda. They could sell bonds. They could open up lines of credit, perhaps. But the idea being, $6 million hole they got to pat. Maybe they can borrow some money. Patch that hole. Or they could issue more stock. Now, you and I can't really issue stock as people, but Jones and Soda could issue more stock, sell more stock to help them plug that hole. And so you could imagine if Jones Soda continues to burn through millions of dollars every single year just in their day-to-day operations, eventually they'll get to the point where there's nothing else to sell off, nobody else will lend them money, and nobody else will buy their stock. And at that point, it's lights out for Jones and Soda. So, operating activities of the cash flow statement day to day. It's complicated. When we use our indirect method, we have to strip away all the accrual accounting. The good news is the other two parts of our cash flow statement are easy, much easier, because we don't have to do any adjustments for accrual accounting. When we look at investing activities and financing activities, all we're looking at is dollars in and dollars out. No worrying about the accrual part. Here's Walmart's cash flows from investing activities. Again, investing activities are the long-term property, plant and equipment purchases and sales, and then also any other long-term investments, buying and selling those. If we look at Walmart, payments for property and equipment, $10.3 billion. You'll notice it has a negative. Negative numbers mean cash is going out. Proceeds from disposal of property and equipment, you can see a positive number. Positive number means cash is coming in. Payments for business acquisitions, cash going out the door. Other investing activities, cash going out the door. So it's easy. No adjustments. You just have to know what goes into that particular part of the cash flow statement. Finally, cash flows from financing activities are our final part of the cash flow statement. I mentioned that includes our long-term debt transactions and our transactions with the shareholders, selling or issuing stock, buying it back, or paying a dividend. Again, positive numbers mean cash is coming in. Negative means cash is going out. Proceeds from issuance of long-term debt, $15.8 billion. They repaid some long-term debt. Notice that's going to show up as a negative. They paid dividends. They bought back their own stock. And those are both going to be negatives. Cash is going out the door. And so you put all that together. You put together the net cash provided by the operating activities. You put together the net cash or net use from investing activities, net cash used in financing activities. You add the three together, you get a net change in cash. And that's the last part of the cash flow statement. Shows you where cash went up or down. So, That's the game we're playing with the cash flow statement. That's a general overview. I'm going to work a few problems as examples to kind of show you how to work homework problems and putting together the cash flow statement. As always, if you do have any questions about what you saw in our lecture video or in the reading or in your homework, I'd be happy to help with any of those issues. Feel free to reach out to me, and we will continue our adventure with a wrap up. We'll wrap up the ratio analysis, our cash flow statement, and then we'll move into managerial accounting. So a lot of fun yet to be had. I hope to see you back here for all of it. Until then, take care, everybody.